This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right, let's go through, finish this chapter off by looking at how we record the impairment in a cash generating unit, or a CGU for short. We've looked at the recording of the impairment for a specific asset. So in that last example, we looked at it for an item of property, plant and equipment, didn't we? Now we're looking at a cash generating unit. What is a cash generating unit? Well, if you're looking at, say, a restaurant or a theme park, there's various assets that are used in a restaurant and various assets that are used in a theme park. Let's take the restaurant as an example. We have the ovens, the fridges, there's all the tables, the chairs, the cash point, the bar. There's lots and lots of assets there within that restaurant. Okay. Now, if there's been a general downturn in the economy, or maybe your performance has been worse than expected and people aren't eating out because they haven't got the disposable income that they previously had, then that's evidence of an impairment, and you would then need to try and impair the asset. But imagine looking at an oven, okay, or a fridge, and saying, right, I know what the carrying value is because I can look at it in my non-current fixed asset register. That's easy enough. But geez, that fridge, I can sell it. I know how much I'd get for it. I know how much it'd cost to sell me. So great, I can work out the fair value less cost to sell. What's the value in use of a fridge? What cash flow does a fridge bring in? I don't know. Okay, so it's going to be pretty difficult, isn't it? So when you're looking at impairing the assets, what we do is we group them together, and you look at the cash generating unit, which is the smallest group of assets that will generate you cash flows together, okay, separately from the rest of the business. So effectively, you've got all these assets within your restaurant business. We're going to go through there and treat them as a collective asset. The cash generating unit is that individual restaurant. Okay. It could be that restaurant is a subsidiary of the parents as part of a group, but we make sure there that before we do any impairment of the group, we impair the individual subsidiary first. So that restaurant. Okay. So I think, is it Gordon Ramsay has some. No, not Gordon Ramsay. Jamie Oliver in the UK has some Italian pizza restaurants, and they've been suffering recently in terms of falling numbers of people visiting the restaurants. The business is struggling, so they'll have probably gone through and done an impairment of the cash generating unit. So looked at each individual restaurant. Okay, because from a restaurant, you know what the cash flows are from that restaurant. You know how much you spend. You know how much comes in. Okay. Likewise, did I mention theme park? So again, if you've got falling numbers at a theme park due to maybe an accident or some other external factors, then therefore you need to look at the theme park as a whole as your cash generating unit. So I think Alton Towers is part of the Merlin Entertainment Group. So maybe you would look at Alton Towers as a cash generating unit. Okay. There we go. The issue then is, how do you allocate the impairment? Now you've got all of these different assets in the theme park, all of these different assets that you have within the restaurant. So what do we impair first? Well, there are set rules. Okay, you've got them there. Okay, the first one is that you impair any specific assets. So if there is a fridge that's broken within the restaurant, or if there is a ride that is now no longer used because of change in people's thrill factor, okay, then you impair that asset first. You will take the impairment to that asset first. Then you will go through there and impair any goodwill. If it's a subsidiary, there will be some goodwill on acquisition within there. What's goodwill? Nothing. Okay. You only need to look at Carillion's financial statements in the UK, a company that recently went bust, doesn't exist any longer. There was £1.6 billion worth, roughly, of goodwill. What's that? Nothing. Yeah, brand name, customer loyalty. Yeah, give me all that rubbish that you've got. Great. It's nothing. It's just an accounting entry, isn't it? So if there's an impairment, let's get rid of it. Okay, it doesn't do anything. Okay, and then once you've done that, you've then got the remaining assets in the business. You will then impair those on a pro rata basis, so splitting it based upon their relative carrying values. Okay, so that's it. Step 1, step 2, step 3. It doesn't change at this point in time. So what we've got is it says, show how the impairment loss in Sharon is allocated amongst the assets. So what we've got there is Peter owned 100% of the equity share capital of Sharon, a wholly owned subsidiary. So that subsidiary will be your cash generating unit. So instead of looking at all the individual assets, we will look at the total asset, which are there, is it, as 17 million. Okay. It says on the reporting date, a fire within one of Sharon's buildings led to an impairment review being carried out. So the fire within the building was the impairment indicator. Because of that, we therefore carried out the impairment review in step 2. So we need to do that impairment review, compare the carrying value to the recoverable amount. If the carrying value is greater than the recoverable amount, there is an impairment. I think there will be, otherwise the question's just pointless. Okay. And what we're told here is that the recoverable amount is 9.8 million. So you've got it there. The carrying value of 17 million is greater than the recoverable amount of 9.8. So does that mean, therefore, that we have an impairment? The impairment is equal to the difference. Is that the 7.2 million? Okay, so that's what you would recognize through profit or loss as the debit. There's no revaluation nonsense going on here. Keep it simple. So we've got an expense of 7,200. What we need to then do is to be able to allocate that to those assets within the CGU. So I think the best way to go through and do it is to go through there and to list the assets out. Okay, so if we go through there and look at the goodwill, that's there at 2,400. The buildings are 6,000. And the plant and equipment are there at 5,200. The other intangibles away from the goodwill are there at 2,000. And then you have, is it your receivables and cash are there at 1,400. So that brings us to, is it 17,000. So effectively what we've done there is we've looked at the value of the assets before. We can then go through there and look at the impairment and then look at allocating that impairment and what the value of the assets are afterwards. We know so far that afterwards the value of the assets is 9,800, and we've said there, haven't we, that therefore the impairment is 7,200, isn't it? That's the difference and the balancing figure, because the carrying value was greater than the recoverable amount. What we need to do is we need to then allocate that specifically following the rules in the standard, don't we? Okay, so it says in that second part, The recoverable amount was 9.8. The fire destroyed some plant and equipment. So it will go to your plant and equipment first because that is a specific asset. With a carrying value of 1.2, and there was no option but to scrap it. So of that 7,200, 1,200 is going to go against that plant and equipment. So that then means there that afterwards the remainder is worth the 4,000. Okay, so that there is step one, applying it to your specific assets. Step two is to then go through there, isn't it, and apply it to the goodwill. Okay, but be careful. Just note there's another one in there. Thought there was. We're also told as well that the other intangibles consist of a license to operate Sharon's plant and equipment. So because we've scrapped some of that plant and equipment, we received an offer to purchase the patent. Is it there for 1.5 million? So the other intangibles we are now being told are worth 1.5 million. So therefore there must be an impairment of 500. Okay. So of the total 7,200, we've allocated 1,700 so far. The 1,200 plus the 500. What we then have, and I'm okay doing this now, is that we then impair the goodwill. So we can impair all of it down to 0 because there's plenty of that total impairment left. And then where are we? We now look at the receivables and the buildings. Okay. Well, the third step is to split it over the remaining assets pro rata. Well, it says in the final paragraph, receivables and cash are both stated at their realizable value and do not require impairment. Well, cash couldn't be impaired anyway, could it? Cash is cash. You either have it or you don't. So that is not impaired. Okay. So that stays at 1,400. So therefore, what we must have now is the rest of the impairment must go to the buildings. Okay. So what have we got? If we go through there and add 2,400, 1,200, and 500, what do we get? 3,600 plus 500 is 4,100, isn't it? Okay. So we've allocated 4,100. There is 7,200 to allocate. So the balancing figure here as part of step 3 is 3,100. Okay. Giving me, is it 2,900? Okay. There we go. And if you were to total up that after column, it should all come to the 9,800, which it does. Okay. I can hear you shouting down the internet once again. Chris, why have you only allocated the impairment to the buildings and not to the rest of the plant and equipment? There's 4,000 there of plant and equipment that you're thinking might be impaired as well. Well, no, because what's happened is we've been specifically told that 1.2 million is to be scrapped. Okay. But there's nothing wrong with anything else. Okay. Everything else is fine. Okay. All the other assets haven't been impacted by the fire. Well, all the other items of plant and equipment haven't been impacted by the fire. So when you're spreading that impairment at the end, pro rata over the assets, it all goes to the buildings. Okay. None of it goes to plant and equipment. None of it goes to the other intangibles because we've been offered 1,500 for it. None of it goes to the receivables or the cash because they are at their carrying value or recoverable amount already, or as it says, realizable value. It's the amount that we would expect to sell it for. So all of the remaining impairment goes there to the buildings. Okay. I'm not going to write the journal entry down. Effectively, what we're going to go through and do there is that we're going to put it in a different color, shall we? Put it in black. We're going to credit the PPE. Oh, careful. Let's get that right way round, shall we? We're going to debit the statement of profit or loss, and then we're going to credit the goodwill. We're going to credit the buildings. We're going to credit the PPE. We're going to credit the other intangibles with each of those amounts there. Okay, and if you've done it correctly, the debits and the credits should balance. Okay. In our exam, it's not going to get any more complicated than what you see there. Okay. So have a practice at some of the questions. Were the examples that are within the study text of your choice, don't ignore them, even though we're not working through another tuition provider's study text. There are examples within there, so work those as well. Work any other questions that there may be on impairment in the study text, and then start thinking about the revision kit questions, okay, that specifically target intangibles. Other than that, that's it for the chapter. Hope you've enjoyed it, and I'll see you all in the next one. Bye for now.